Well, today on Rethink Real Estate, we have Laura Phillips. She is a reverse mortgage specialist in Colorado, Arizona, California, and Florida. Now, some of you might be thinking, well, why are we having another reverse mortgage person on? We actually got a lot of questions from the community that listened to Rethink Real Estate about reverse mortgages. There was a lot of questions about the fees and how it worked and everything like that, which I think I do a good job of covering off with Laura today. She's pretty transparent and open with all of that. But there was also a lot of negative comments about the reverse mortgage industry, what it was. I didn't really understand that, and ultimately, I find this product fascinating. I really do, because at the end of the day, there's so much planning when it comes to retirement where I give an example of my parents going through a problem with it at the moment that they have to repurchase in a marketplace. And my dad is of the mentality that ultimately he doesn't want to rent, just that older generation don't want to rent, and so on and so forth. But again, I find the product fascinating from a retirement perspective. I'm going through retirement stuff at the moment, just from a planning perspective. And I do believe that this is an opportunity for us to understand and help plan with our clients better, to understand different opportunities that they are there as well. Because not only do you sell their property, they can also have a reverse mortgage when they're purchasing on the other side of it also. And this can be a really great conversation with some of that older generation. As I mentioned here, there is about $80 trillion that is going to change hands here in the next number of years, from baby boomers through to their kids. And a lot of that is great, but it's controlled by 10% of the baby boomers control that $80 trillion. The others, their primary asset is the only money they ultimately have. So this can be a big help. Thanks so much. Welcome to Rethink Real Estate. My name is Ben Brady, and this is a real estate podcast aimed to deliver sales strategies, marketing tips, and business insights from industry experts and myself to build a listing-focused business for the future. Let's get into it. Laura, welcome to Rethink Real Estate.
Thanks for having me on, Brett. I appreciate it.
No problem.
Thanks so much.
Do you know what? You can call me, Laura, you can call me whatever you like, okay? Most of the people that are listening, they do the same, so it's fine. Okay?
I'll go with Ben.
Now, I think a good place to start here is just referencing, why do we have somebody else on where we had another person on already talking about reverse mortgages? We got a lot of questions from the community about it, people saying they didn't understand it fully. They wanted to know fees. And I thought it'd be great to bring somebody different on. I wanted to start off, let's talk about first question, because there was some negative comments that we got about it as well. And I think that that's something we probably should address from the very beginning. What was reverse mortgages versus what is it today? Because I did my own little bit of research, and yeah, sure, in the past, I think there was some predatory lending stuff that went on. But with it being as regulated as ultimately it is now, I see it as a real positive and a really interesting product. So I'd love you to give us a bit of an insight, a bit of a history lesson on what was reverse mortgages and what is it today.
Absolutely. Well, first of all, I think reverse mortgages did earn that negative reputation in the beginning, in the early days. And it came out during President Reagan's era. And the original thought, or the original ones that came out, was to try to help a couple of widows keep their homes and raise their children. Eventually was signed in as a HUD product, so it is a government-based product, but there were a lot of things they didn't think about in the early days. So I say it's not your grandmother's reverse mortgage, because we're thinking of our grandparents who got it, and it is a kinder and gentler product. So a couple of things that really had it earn that negative reputation was that they only put one person on the loan. So typically in the early days, the Reagan era, the man was the main household income earner. So they didn't put the wife on the loan. And when he passed, traditionally, he's older, he passed away. Unfortunately, the wife became the widow and was literally on the street. So we had grandma on the street, booted out of the house, because nobody thought about her and living in the home. So that law has been changed, and now we put both spouses on the loan. We work with the youngest member's age, which is, again, typically the wife, although there are some, other situations, but we still work with the youngest member's age, and therefore protecting their rights to be able to stay in the home after their significant other and spouse passed. That it was one of the big reasons that it got the negative image, negative image was, of course, grandma on the street crying with no home to live in. The other one was the seniors getting foreclosed on. The other thing, when the loans first came out, was they gave no thought to could they afford their property taxes and their insurance, their HOA dues? So the other thing that went along with that was they were giving about 75% of equity to
Right.
the clients. So, wow, that was a great, boost to income, but a lot of people never even looked to see if they had enough coming in with Social Security and retirement funds to make their yearly tax payment, their yearly homeowners insurance payment, and HOA
Okay.
dues. Consequently, tax liens cut in front of all mortgages, and a reverse mortgage is still a mortgage, and therefore they were foreclosed on. So now we've got another whole set of senior citizens sitting on the street being very unhappy about having lost their homes. Again, those rules changed. We make sure that we do an assessment, a financial assessment. We want to make sure that enough money comes in to be able to cover the taxes, the insurance, and the HOAs on a yearly basis. And so basically, we've prevented those situations from happening going forward.
I think that's so it's kind of interesting in the sense that, like, for example, 2008, 2009 happened, the mortgage industry gets overhauled.
Right.
And the reality of that is now that we have a whole bunch of people. Now we're going through a transitional marketplace this year where a great deal of North America is ultimately not the greatest real estate market to sell homes. And I think that there's a lot of people that are very secure in their financial position because of the way that the lending practices work now, in the sense of making sure that people put 20% down and all of those different fundamentals in most homes now. And I think that that's proven to be a benefactor in the mortgage industry, in the sense that, yes, it's a little overregulated. Yes, it's really difficult to get a mortgage, but
Mhm.
at the end of the day, it's safeguarding it. And I think that that is what I'm taking out of the reverse mortgage process, is that
Mhm.
that is what's happened, is that there's some safeguards in place. Now,
Good.
now I think that there's a part of this, there's a question that I'm going to ask you that might be a little out of left field, but maybe not, is people are living so much longer now. Can
Mhm.
you see that becoming a problem from the reverse mortgage side of things, that eventually the property could be underwater? Because the fees of a reverse mortgage was another massive question that we did get within the community, of that,
Mhm.
yes, but it's all good and well to say that they don't have to pay anything apart from their property tax and HOAs or obligations of utilities. But by the end of it, there's nothing really left for them. And sorry, this is a long-winded response and comment, Laura, so forgive me, but we're in the middle of a transition where over $80 trillion worth of wealth is going to transition from baby boomers through to
Mhm.
their children. And that there's that's all good and well. For that 80 trillion, that actually only represents probably about 10% of the baby boomers, because then there's this 90% of them that may own real estate, hopefully, or there are a lot of them, probably their primary net worth is held in their primary asset. So there is this element of legacy as well, is that mum and dad, or grandma and grandpa, or whoever it is, they want to retire, or they want to live their final years with some money in their pocket and not have to worry about that. But they also don't want to become a burden, or leave any type of burden for their kids either. So just walk us through, maybe a long-winded response, question, comment is what I've had given you, but maybe let's walk through fees. Maybe let's walk through, the nature of, people living longer, and will it be eventually underwater possibly? Like, just let's go through some of that stuff.
Absolutely. So, wow, there were quite a few questions in there, but let's talk about the one underwater, because I heard that and that was the one
Yeah,
you made
let's do that one. Let's do
so,
that one.
so we'll
Perfect.
talk with that one first. So, yes, it is very possible that the home could be upside down at the end of a person's lifetime. We figure on 30 years. So, with the exception of my 95-year-old gentleman who did one, and we only did it out 20. So, again, he even said, I'm not going to live that long. But an average person at, say, 70 years old, we're going to figure them to be about 100. If they were to live that long in their house, it's very, very good, strong possibility that it would be upside down. But keep in mind, that's a 30-year time span
Right,
of
right.
collecting the interest on the loan. And it's compounding each month through the years over. So that is going to, and I point that out. I want to make sure that people see that. I don't want to highlight it in red, but we go to the end and say, if you think you're going to be in the house this long, then this is how much equity will be left over. People say I'm going to live to 100, then the answer would be very likely that it will be upside down. So now what happens if it's upside down? Because now we're going to talk about that legacy of, like, giving it to the children. So,
Mm.
do they inherit the debt that the parent had from the reverse mortgage? And the answer is no.
Okay.
The expensive piece to this loan is the mortgage insurance, and that protects the homeowner and their heirs from not having to pay any difference if the house is upside down versus the mortgage. So, we call it a non recourse loan. So, I think I've covered a couple of those pieces in that just that answer right there. It
Yeah.
is an expensive loan. It's not for everybody. If the parents really, or parents of the senior, we'll use the word seniors, if they want to leave the house to a family member, it may not be the best loan option. I think at that point, it's a conversation that you need to dive deeper than just saying, I need some equity. Like, what is the plan behind this? And how much equity you need? How much money do you need to live? And
Mm.
how, if we can leave it to the children, they have a potential to be able to buy it at 95% of the loan value. Now, there's some rules and guidelines behind that, but that's in essence the reason behind it. So, if your children, could they afford a $400,000 loan? I mean, we'll kind of look and see what do you think your children can afford, and is this a possibility? And if they tell me no, I really want it to be free and clear, then I will say it's not a good product for you to look at. Let's
Yeah.
come up with another way.
Laura, it's really interesting to hear you talk about this. These are the nuances that we didn't get in the first time around because, like, I think I want to get a little scenario based, if that's okay with
Okay,
you.
I'll
Yeah,
try. I'll do
yeah,
the best
yeah,
I
yeah. I think you're ready to go with it because it's fairly simple. Because I just want to just double click on a point that you just made there.
can.
So let's say that, and again, obviously, this is conditionally based. Okay, we're not making any guarantees here, of course. But let's say that mum and dad, or dad's left there in the home, and he needs to certain amount of money to live for a period of time, and the
Mm-hmm.
home is worth $1 million.
Right.
Okay, he owns the home clean and clear. Say, let's say it's just $1
Mm-hmm.
million, and
Okay.
then we get a valuation on the property. Or sorry, we get an appraisal on the property.
Right.
They can get up to 50%. Is that right?
Depending on age, there's actually so all the realtors are out there know about the HP12 calculator. We all know we can pull it out and we can calculate interest and what it's going to take to make a mortgage payment on our little trusty calculators. Oh, I've got one right here. So I think
Right.
everybody has seen these and know how to operate these. I can't do that with a reverse mortgage. I have to pull it up on my computer because there are three moving gears that
Okay.
calculate how much money you're going to get out. One of them is the age of the person. So
Okay.
as you get older, it's one of the few things in life where it's a benefit, besides going to the movies for a little bit less. It's a benefit. So each year that you're a little bit older, you're allowed to access a little bit more equity. Great. Um, then there's the house value, and is there a lien against it? So that's the second gear. And then the third gear is, what kind of loan product are we looking at? Are we looking at a fixed rate? Or are we looking at an adjustable rate? And that would be the interest rate. So all three of these they kick together, and they kind of spit out a number. So the number can be as low as 40% and as high as 70. So my 85-year-old gentleman got 70% of
Mm.
his equity. My people who are looking at it at 65 are only getting 40%. So that's the span and the difference. And that was based on um, well, nobody's really doing them right now because interest rates are high. Very full disclosure, interest rates are high. So that would have really been based more on last year's interest rates, who were a little bit better. So
Right,
yeah,
right. Well, it's okay. So then that's great. Between 40 and 70%, depending on age, the
right,
older you are, ultimately, the more equity comes out. That makes a great deal of sense, of course.
right.
Now that being said, so then the other thing that I thought I heard you say, and correct me if I'm wrong here, is that let's say that dad passes away, unfortunately,
Mhm.
and the balance that is then that was taken plus was, let's just use round numbers, 50%. So we got $500,000 out of the property. Okay.
Okay.
Now, then the accumulation of interest, let's call it another $200,000 over the span. I'm just
Hmm.
making up numbers at this point,
Right.
so
I do the
forgive
same
me.
thing.
Yeah, yeah. So that's $700,000.
Right.
So that leaves $300,000 worth of equity in the property. Now
Correct.
that to be said, you said something where, can the kids buy the property for or take over the loan for 95% of the mortgage that's is
They
there,
can't
or
actually take over the loan because the loan is, you have to be
sorry.
at least 62, let me see, 62 years old to be able to
Yep.
get it.
Okay.
I think that's right. Sorry. I do them all day long and then I don't remember the real numbers sometimes, and I
Yeah.
apologize.
Yeah.
I'm
Yeah. No,
thinking you have
that's
to be in
fine.
your mid 60s to get the
That's
loans, just on the
that's
safe
fine.
side. So, no, they would have to go out and get a new loan at the
Yep.
$700,000 number to be able to buy the house if they wanted to keep it.
Okay.
However, the house has got equity in it. It's
Mm.
got $300,000 stuffed over. They could turn around and sell it. Now, let's assume that it accumulated a rate of rate of value of about 4%. So there actually may be more value in the home than when he first took it out. So it might
Yeah.
make more sense, to be honest with you, is to sell it than to buy it. Just
Yeah.
at that point. But yeah,
Yeah.
they
No.
have
No. Good
options.
point. That's a
Yeah,
good point as well, because not many people take into consideration what the compounding effect of the real estate value ultimately will be, because you at least get inflation value on it anyway. But
kind of. Yeah,
the other point of like in all of that is like, it's like in a retirement perspective, there's a lot of people that are like, I'm looking for a safe option. So you go and get a Charles Schwab dividend, you go put $1 million into it, you get like, oh yeah, but it only pays you 3.5%. But they don't equate for the sell down that you can have of between 4 and 8% every year based on the gain that ultimately historically might happen. So all of that to be said then is that I guess that behind the scenes in all of this, I'm really curious to understand, I guess, what the rates are typically versus, your normal 30-year mortgage, right? So like, let's say that I can go out there right now and say I've got okay credit and I can go and get a mortgage for roughly between 6.5% and 7%, or maybe 6 and 6.5 if I'm really good, well qualified, maybe not.
right.
Okay. What is the rate typically going to be that it accumulates on a reverse mortgage?
Well, it's a HUD product. So it's a government regulated product, and we follow the FHA rules pretty closely. And same with the interest rates. So we have two loans. We have a fixed rate loan and we have an adjustable rate. I haven't seen a fixed rate loan done in the last 5 years. Everybody is looking at least that come to me, are looking for getting an adjustable rate.
Of
And the
course.
reason for that is that it has a line of credit that grows separate to the interest on the loan. So there's two buckets and they are both growing and they're both accessed differently. So the line of credit grows at almost the same as the interest rate. So if we were looking at interest rates on those lines of credit have to do with the margin. So the lower the margin versus the higher the margin. So that kind of depends on how much equity they know. That's a subset of that interest rate with that gear turning. So
Got
like
it.
I said,
Got it.
that's why I can't just pull out my trusty calculator.
No, no,
And
no,
say,
no. I see.
"Hey,
I see. I see.
right,
But Laura, I want to ask that because I
sure,
didn't ask it last time, because the
okay,
gentleman did mention there we do get a line of credit. I don't
yeah."
understand. Can you explain to me how that is baked in and how that works?
I think it's the sweetest part of looking at a reverse mortgage. So let me go back and say your family friend that you were mentioning did a Charles Schwab, and let's just say he put in $500,000 into Charles Schwab,
Mhm.
and they were okay to live on their own income. They did they didn't want to, and one of those was Apple. Oh my God, they bought Apple back when it was a baby, and people thought you had to eat it. so but they wanted to pass that on to their heirs, and they had
Yep.
enough money to live on. So, but they didn't want to touch that uh, asset, the stock market asset. So they took out a reverse mortgage. They didn't care. The kids all had homes that were happy in their homes. They didn't really want mom and dad's home. They were okay with spending down that house. And they used their line of credit to grow. And that particular example, it grew to $2 million over the time of their lifetime. Plus, they were able to give the stock to their children. So that it's equity and it
Mhm.
just grows. And so that line of credit is there when they got close to passing. They just took it out and dispersed it to their children at that point.
Right. Okay.
I know that seems a little confusing. So
Touch.
it is. I mean, I won't lie. It is confusing, but it does work. And that line of credit is a sweet spot.
Okay. Well, I think that there's a few, like, I wouldn't mind from you getting a couple. Now, obviously, that we need to be careful when it comes to you giving away too much information on people's personal situations. So
Right.
let's not use names. Let's not use, maybe we use some round numbers. But like, I've got my own situation here. Like, there's like, I'm fortunate enough that I do well for myself, that I can pay for my mum or my dad as they get older, that ultimately that they will never want for anything, so to speak. However, the reality is that mum and dad are never going to leave me and my sister anything, nothing, right? And that's the way that we want it to be, kind of. Like,
Mhm.
mum and dad's primary asset at the moment is their house.
Mhm.
We want them to sell it and just live out their years, maybe in a smaller home, and so on and so
Right.
forth. But this is a massive issue for my parents at the moment, and they're right around the ages that we're talking about here.
Okay.
Is that mum and dad are about to sell their home for $1.8 million in Australia. Now, by the way, dad bought the home. My dad bought the home 11 years ago for $750,000.
So
Okay.
it's appreciated quite nicely.
Beautifully, amazing. However, the problem has been is, whilst their property is appreciated, so is every single other marketplace that they want to move into from a retirement perspective. They want to
Right.
move close to my sister for grandparents, being grandparents, all this type of stuff. My sister also needs to do some travel for work, so they wanted to get the house in a position that helps. Now,
Mhm.
the long story short is that mum and dad are probably like, they're like, oh, great, well, we get to retire. They've got 401k, they've got some other stuff that they could live on, but they genuinely have to spend 75% of the proceeds that they get out of their home on another property. And I said to dad, Dad, just rent. And he's like, I'm not renting. There's no way I'm renting. Like, it's just a
Right.
big mentality for my dad at the
It
age that
is.
he
For
is.
that generation, it's like throwing money away. I get that. Yeah.
Yeah, yeah. When ultimately it probably would cost him less, really. But anyway, it doesn't matter. But long story short here is that in Australia and New Zealand, there is not a reverse mortgage product. And mum and dad are going to legitimately have to spend $1.5 million to buy a property that is half of what they have at the moment, in a location that suits them from a retirement perspective. And to be honest, is that mum and dad are, they're going to be fine. But realistically, is that if they could get a reverse mortgage and live out their final years having plenty of money in their bank account, I don't want the money. Vanessa, my little sister, doesn't want the money either. We want them to have a great remainder of the years. Now, don't get me wrong, they've got probably 30 odd years left at least.
Right.
But the reality is that this product allows people to have that freedom. So that's one of my own personal circumstances in a country where at the moment in Australia and New Zealand doesn't work. But here locally,
Here in the
could
States, yeah.
yeah, in the States,
Yeah.
could you give some examples of situations that you deal with on a daily basis that might help the community that's listening understand where this could work?
Well, let's talk about wanting to sell the home
Yep,
and downsize. Because let's face it, most of the seniors that are out there are living in the home that they raised their children in. At
sure.
least 2 stories, or it's got 5 bedrooms. It might have acreage that they have to take care of in landscaping, or pay somebody to come do that. I mean, it doesn't really suit their lifestyle any longer
Exactly.
in so many ways. And so they do want to sell it. And absolutely, home values have gone up across everywhere in the US. And so they're looking at, like you said, anybody taking a senior here, taking at least 75% to be able to buy. If not more, using all of it to buy a smaller place. But there is a product within the reverse bubble that is called H for P. It's reverse for purchase, or
Mm,
HECM for purchase. So I did one from a girlfriend who moved from Colorado to Arizona to be closer to her brother. She
mm.
had 2.5 acres and a kind of a dog farm, dog kennel. She raised dogs, dog farm.
Got it.
And
Got it.
so,
Got it.
and she was done with that. She was totally done with that. She wanted to move closer to
It's
her.
actually, that's a good point. That's a good point, Laura. It's like dog farm, or is it a dog stable, or is it? I'm like
Yeah,
thinking, what is the real? I don't know.
I had to think about. I
Yeah,
think we'll call it a kennel, but she wasn't boarding. She was breeder. She was a
got it.
breeder with the
Got it.
dogs. So she sold her home, and she paid off a reverse. She had a reverse on her home, and she sold it, and she walked away with about $500,000. So most people think, "Wow, I've hit the jackpot!" Right? I mean,
Mm,
it felt really good. She went to Arizona, and the prices of the homes in Arizona were about 375 to 400. So she's looking at that $500,000 pocket of money that she got, and thinking, "Wow, if I have to put it all down, that's not a lot left over to live on." she had Social Security, but she's thinking, as we get older, surprisingly, things come at us from the medical world that cost way more than we ever thought about.
Yeah.
So she was all concerned about that. So we looked at a reverse mortgage to purchase her house in Arizona, and she came to the table with a home that was close to, I'm going to use round numbers off the top of my head, $400,000, and she came to the table with about $260,000. And the rest of that $500,000 is in her bank account to help support her through the rest of her living years, along with whatever she's coming in from other retirement funds. So
Right.
yes, you can use a reverse. And she came in with about 65% of the loan to come in and buy that home, and I'm sorry that Australia doesn't have it. You do have a great product, but a huge backlog of getting loans through. I just saw that in the news recently.
Yeah.
And this product called Reverse or something for seniors is out in 25, 30 nations that are trying to help their seniors stay and live in them. So it's not like some fly by night product that people think, they use, well, I don't want to say that either.
Yeah.
The guy at the circus is trying to get you to pick where the peanut was underneath the cups. It's shilling. It's not that. It's not that. This product's in Canada, it's in England, it's in Australia, it's in New Zealand, it's in Japan, it's in Korea. I mean, I can go on and on about how these countries, including our own here in the US, want to figure out how to make it so the seniors can live comfortably in their home.
Well, I think that's definitely, and I guess it's a bit of a diversion, different topic. I think the one thing that Australia has done incredibly well is that Australia's superannuation is what it's called. It's 401k. Is that every employer has to contribute between 9 and 12% of your wage goes into a 401k. So it's funny, for a population of 20, I think it's 25 million people, we have a larger social security fund than all of the US combined. So it's funny how like different initiatives obviously create different inhabitants for as it comes to that retirement side of it. But it's just something that I'm fascinated with at the moment, Laura, because I'm 36 years of age. Retirement is a long, long way away from me, and it's funny. The reality is that I think that people have gotten to a point within their lives where they will say, quite often than not, when you ask people what their plan is, because we have a large real estate community, we have a large real estate business where, the average age of our realtors is a little higher than what I think it might be in other countries. And you start asking them about their plans for the end of life, and most of them often say, well, I'll never retire. And I really do believe that they say that because they don't know how to. Okay. And part of that is, I believe, not understanding these types of products that are available to people.
Right.
And there's just not enough planning that goes on in this situation in order for them to understand that you don't have to contribute so much of your earnings to 401k or to different retirement things. It can be in the primary asset of your home as well. And I think that this is a really good insight. Do you think we've missed anything today, Laura?
Well, I think people are afraid of them. Because if you go talk to your friend, your neighbor, somebody from church, I don't know, the guy on the street with the coffee cup, they're going to go, oh, God, don't do that. And it's because nobody really has sat down and had a conversation about their unique situation. And it is unique. It's individual to each individual party as to whether it'll work. I say to anybody who's listening, if it perks your interest at all, reach out to a reverse mortgage lender. Reach out to me. I don't lend in all of the states, but
Sorry, Colorado, Arizona, Florida, and California.
Yep.
Is that right? Yeah, that's where you're at. Yeah, great.
Yep. Right. But I can, even with not lending in those states, I can kind of give you a rough ballpark of what might happen, and I can give you a referral. They wouldn't be with my company, but I've had some people that I've partnered with in other states to help get a loan through, and that was successful. So I think that's, I'd say ask, talk. And if somebody says, a lot of people lots of loan officers will say, hey, I can do a reverse. And I suppose that's true. If you pull up the computer, you can do it. But to know the ins and outs, the real ways that's going to make it work for you.
To have the case studies that you have as well from the circumstances that you've done for so many of them, I think that is worth its weight in gold.
Would you see a GP for brain surgery? No.
No.
So let's go to a professional who actually says they do reverse mortgages, and I do it full time. And that that person's going to be the best resource to help you figure out if it's good. I've had clients that have been on my list for 4 years. We talk every year. Is this the right time? We look at the numbers, and and it's their choice, and they're going, no, not quite yet. That's fine. That's the way it should be. It needs to be your choice.
Wonderful. Well, we're going to make sure that all your information is in the show notes below. We really appreciate the insights that you've given. I think you've got a great consultative approach that you'll be able to help many people in this situation. And even if it's just to have the right contact at the right time, I think that I encourage everybody to reach out to Laura, so that then you're another person in their wheelhouse of people that they can offer anybody that ultimately comes their way. So, Laura, thank you for joining us on Rethink Real Estate. Very insightful.
Thank you, Ben. I really appreciate being on board.
So about 75% of our audience hasn't liked, followed, or subscribed to our podcast. It would mean the world to us, and it would help this podcast more than you know to expand our reach if you were to like, follow, or subscribe on any of the platforms that you're watching or listening on. Thanks again.